Hey team, welcome to Money News in Human Words, and I'm pumped to be bringing you our first live podcast for the year. Bringing it to you live and direct from the Philippines. We're over here catching up with the Pivot Wealth offshore team, and a little bit of a change of scenery over this week. But look, guys, I'm pumped to be back with you. I love the New Year time, personally and professionally. I feel like anything is possible in the new year. Brings a lot of motivation to tick off some goals, create some new goals, celebrate the progress that's been made, and where to from here. Certainly, we're seeing a ton of people that are pumped up to make this year the year that they level up their money game. And I think when it comes to money, it's not easy. So you want to use every hack to your advantage that you can. So yeah, I think take advantage of that one. So look, I got a bit to cover this week, but the first piece I'm bringing for this week is actually based on a bunch of feedback that I've been getting from people on our client stories. They said that they wanted to hear more about that, learning about the tactics that other people have used to get money results. So the first story I've got for you guys this week is all about holiday home tactics and mortgage freedom. So this is a really interesting one. A couple we've been working with for a little while. Through the planning work that we did with them, they managed to implement a bunch of tactics that created an upside of $82,000 in the first 12 months, including a tax saving of over $17,000 in year one. So I'm going to unpack exactly what they did, where they were at, and how they made that happen. So this is a couple. They were aged 46 and 47, a couple of young kids. Incomes were pretty solid at 260K and 340K, and they were saving a really solid 10 grand a month. Total asset position $3 million, which is made up of their home, 2.6 mil, with $900,000 in mortgage debt attached to it. They had a holiday home that they bought down the south coast in Sydney, 850K with a $600,000 mortgage against it. Super $660,000, $325,000 in cash, and $65,000 in shares in random tech companies. Now, these guys came to us frustrated with the fact that they didn't really have any tax planning in place. They had a loose understanding of tax, but didn't really know the ins and outs of the tactics and strategies that could actually help with that. What they really wanted to do was upgrade their family home, which was already lovely, but they wanted something with a bit more space to give them an extra bedroom, essentially. But they were worried because they recently purchased this holiday home, which was something that they really wanted to do to create a space for their young family to be able to have some getaways. And they knew that when they started doing that, they knew that it wasn't going to be necessarily the very best financial decision, because they're having to carry that extra mortgage, but not getting an extra income stream to come along with it. And that plus then upgrading their family home, they didn't want to be forced working forever, and they were worried that they were going to be never going to be mortgage free. Now, essentially what they were doing when they came to us was saving in an offset and paying down their mortgage, because they knew that they had some work ahead of them to get debt free on both their home and their holiday home, which was something that they saw as an important definition of success. And in addition, they were doing a little bit of random shares into these tech companies, which was there, but it was pretty small potatoes in the grand scheme of things. So after we went through the process and sort of looked at where things were at and what was actually possible, they made a couple of shifts that had a really big impact. The first thing that they did was started Airbnb renting their holiday home. They weren't using it that much anyway, and they weren't really too pumped about doing that before they got into it, because they wanted it to be easy, wanted to just be set up for them. But when they looked at the numbers and the impact, they recognized that was one of the best things for them to do. At the same time, they sold down their shares in the random tech shares. They actually hadn't been performing that well through 2022. They recognized that they wanted to invest in a more diversified way, but they sold down the shares and then switched over to using an investment bond structure, which is a structure where essentially, if you invest for longer than 10 years, you basically don't pay any capital gains tax on the growth of your investments, which can create a pretty substantial tax saving for these guys, because they were in a strong cash flow position and they didn't need the money in the shorter term. It really was long-term investing. So for them, that made a lot of sense. Also maxing out their super contributions to get more tax deductions and build their super at the same time. switching their super fund over to a low-cost index fund option, and used catch-up super contributions of $10,000. Now, with the catch-up super contributions, basically, if you haven't used any of your full $27,500 contribution limit, and your super fund balance is below $500,000, you can basically catch up on 5 years worth of unused contributions, which allows most people to put in, $25,000 at least, sometimes up to, $100,000 or thereabouts, and claim a tax deduction for that and get it into the low tax super environment. Now, because these guys had a high income and they were above the threshold for the extra super high income earners tax, which kicks in at 250K, they didn't want to actually max out their catch-up contributions, but they figured that $10,000 would get them some extra tax deductions and get a bit more money into super. So it was something that made sense for them. What they also did was purchase an investment property at $900,000 with a view to purchasing another investment property in the next 12 months. And they delayed their home upgrade slightly to planning for that in 8 years' time, to give them the advantage of another, hopefully at least one property market upswing cycle for them in that as well. They also, in doing that, gave themselves the option to see whether, it still was the very most important thing to do for them at that time, given that it is, does come with a significant cost in doing that. So basically those tactics, the impact of those tactics were broken down, those here. So essentially the Airbnb on the holiday home, that created an uplift of $35,000 in the first 12 months. Selling down shares and switching to an investment bond, tax saving of $4,000 in year one, but that was then increasing. Plus there's unknown upside from exiting their pretty average investments that they were in before. Maxing out their super contributions, that created a tax saving of $1,500. Switching their super fund to a low-cost index fund option created a fee saving on the super product of $5,000 a year. Catch-up super contributions, another $1,500 in tax savings. Investment property at $900,000, net upside after funding all of the extra mortgage payments, even with the current high interest rate environment. After funding all of that, the net upside from a wealth building perspective for $43,200 over 12 months. Total upside from those tactics, $92,200. They paid $18,000 for their advice before tax deductions over the first 12 months. So net upside being $74,200 after advice fees, increasing that in the first 12 months, then increasing to $4.4 million over year 20. And to me, this shows that, there's a lot of different ways to be right. A lot of people talk about, holiday homes are a bad idea. Holiday homes can be a great idea. Upgrading your home, good idea. Bad idea, great idea. But really, the right decisions for these guys only became clear when they unpacked the numbers and knew what was actually possible for them. And when we did that, they made decisions that were really quite different to what they thought they were going to be before. So particularly this time of year, as you're setting goals and figuring out what you should be focused on or what you want to be focused on, understand those numbers in detail, and you're going to come and make much better choices as a result. Getting into the news over last week, the first piece that caught my eye was about the RBA and their potential to cut rates through this year. Basically, it's looking like the consensus view from the experts out there, I'll use that term a little bit loosely given the difficulties with forecasting over the last little bit, but essentially tipping 2 further rate rises before interest rates pause and then start easing. The RBA has come out saying they don't have a preset course, and they're going to be looking closely at the data and the numbers to see where to from here. Obviously, there's a lot of Aussies playing catch up with the massive rate rises that we've seen over the last little bit, and a lot of people that are coming off fixed rates this year, so that the RBA are looking quite closely at that and the impact of that. But at this point, the consensus is a couple more interest rate rises and then a pause, followed by declines later this year for the majority of forecasters, and some are predicting into next year. Now, we've seen, I think it was CBA came out talking about that things could be coming out, interest rates could be coming down by March, actually it was MLC, so MLC, NAB, they're talking about potentially August, the interest rate starting to decline. CBA is saying October, and there's a few people at the other end of the spectrum saying that interest rates will not fall until at least 2025. Either way, it's looking like that the government and the RBA treading the fine line between recession and not. Obviously, they're trying to avoid recession at all costs, but they do need to tame this inflation beast. So it is a bit of a line ball call. We'll see what the data says, and the next RBA meeting is coming up in early February. That will be an interesting one, but most people are predicting that there will be one further interest rate rise. I think if we don't get that a lot of people will be pleasantly surprised, but it seems like thankfully we're sort of getting to the end of the tightening cycle at least, and some reprieve is in sight. Some more good news, and look at another piece last week talking about GFC level declines being predicted from the share market. Basically, Morgan Stanley has come out saying that they feel that the investment declines in 2023 could rival the levels seen in the global financial crisis in 2007, 2008, with the main reason for their view on that being the poor earnings outlook for a lot of companies. So when a lot of companies are forecasting their earnings, or when these banks are forecasting other companies' earnings, they're saying that the weaker earnings outlook is going to have a significant impact on valuations. Now, when I read this, I just think about all the money I'm going to make investing in 2023. Now, I've got a bunch of investments, and they may cop a hit, likely will cop a bit of a hit when markets decline, because good investments go down when markets go down. But a lot of people think about selling when they see that, and think that they're going to time out the market, cash out their investments now, jump back in and pick up some bargain. But we know from experience that timing the market is super difficult and scary, and pretty much impossible unless you get super lucky. Now, I don't back myself to do that, like we don't back our clients to do that, or back ourselves to do that for our clients. So I'll just be keeping my investments sitting tight. I know that the investments that I've got in my portfolio are set up for the long term, and I'll be adding a bunch to them this year, and hoping to take advantage of some of the conditions that we saw in 2009. I think that the stats are showing us, and I was a bit disheartened to see some of the stats that a lot of people have stopped investing, or investing less, are exiting investments, particularly younger people. And look, I totally get that when cost of living pressures are increasing, it means that there's a bit less money available for people to invest. But this is the time where you want to make sure that you're preserving how much is going into the market, trying to find ways to cut costs in other areas so that you can preserve your savings and investment cash flow, because downturns make millionaires. And these are the times when you want to be keeping your investments going at the same level, if not increasing your investments, so you make more money when the market conditions turn in your favor. And we never know where things are going to go. In fact, I was looking at, it was interesting seeing this thing, Morgan Stanley predicting that this is where the market's going to end up at the back end of the year. But looking at the consensus Wall Street forecast for 2022 just finished, the forecasts on average had the market ending the year at 4,800 points. In fact, what happened is we ended the year closer to 3,800 points. So the forecasters don't know. And while it is likely that we're going to see some more declines before we see an up, that we could see some ups, and something unexpected could happen, and we could go the other way. So if you're waiting on the sidelines, you're going to miss the boat for sure. Interesting one that came out just over in between the Christmas and New Year period, that NAB came out offering mortgage holidays to new parents. They basically came out saying that for anyone that is on paternity leave or parental leave or going on parental leave in the next month, they can basically not pay 75% of their mortgage payments. So look, I think this is a great initiative that will no doubt help a bunch of people, particularly when you're going through that maternity leave, time out of the workforce, lower income period. It is a challenging thing to manage. But I think that for anyone considering going down that path, you've got to be careful, because we saw when the mortgage and debt holidays were happening through the COVID pandemic, that it does actually add on to your loan, and means that post the repayment holiday period, that you do have to pay higher payments, and then your mortgage lasts longer. Also, for a lot of people, it impacted their ability to borrow or refinance their existing borrowings, because they had taken advantage of that fee holiday. So just understand what that is before you jump in. The other interesting thing that I thought when I saw this is it sort of shows, and it's the first indication that I've seen of the bank's willingness to make sure that there isn't going to be, large-scale defaults across the property market. If people start defaulting on their mortgages or start fire sailing properties, that's a terrible outcome for the banks, because the banks are essentially the biggest landowners in the country. And I've spoken about this on the podcast before, that I think that the banks will be committed to making sure that that doesn't actually happen. So this is the first move of I think what will be a number of moves in this space. Will be interesting to see whether the other banks follow suit, or how they follow suit, or what initiatives they bring out. But certainly easing the pressure for new parents, easing the pressure on property values as well. Guys, that's it from me for this week. Great to be back with you. I will catch you on the next one.